This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
All right, everybody, welcome to the show. And Andy and I were talking, and first we just want to say thank you for listening. We really appreciate it. If you're watching on YouTube, thank you so much. I know all of you are grateful for Andy, and I'm grateful for Andy too. So just want to thank you for listening. Thank you for giving us your time. And now let's get to the show. This show's a little different. On most shows, we always talk about the Warren Buffett strategy of investing. And a lot of times we talk about what we call value investing or the fundamentals of investing. But there's also a whole nother side that Andy teaches, and that's technical investing. And one of the things Robert always says is there's two sides to every coin, but there's also a third side where you stand on the edge, and that's where you can make an honest decision. So what we want to do is present both sides. Well, actually, let me rephrase. We've already presented fundamental value investing, but now we want to present to you technical investing so that while you're on the edge of that coin, you can kind of see what works best for you. At least learn a bit about technical investing so that maybe you see the value in fundamental investing. Either way, we've asked Andy to come and teach us about technical investing. And if I could just add one more thing, Andy, before I bring you in, I was playing the cash flow board game. And you know, when you get a stock card, it doesn't give you any of the fundamentals of the business. What it does is it tells you, here's the probable low price, here's the probable high price. And then you make your decision based on that. Which way do you think it's going to go? To me, that's basically the game teaching you more of the mindset of technical investing, not fundamental. So with that, I guess I'm saying that technical investing is everywhere. It's a big deal. It's not the second fiddle to fundamental investing to most people. And so this is a show we really need to listen to and get the other side of the coin. So with that, Andy, come on in.
Well, first of all, Greg, thanks for having me. I enjoy our conversations and look forward to them each and every week. This is one of the highlights of my week where we get together, and I'm grateful. I feel humbled that so many people watch and make nice comments, and I'm a human being, so that makes me feel good. And so I'm just grateful. And I feel humbled to be a student alongside everyone else. So that's awesome. So technical investing. So when people look to buy a stock or buy any asset for that matter, they feel like the more they know about it, the more informed they are, the better off they'll be. We can never eliminate risk, but the more we know about something, the better off we are. So let's separate fundamentals and technicals, just briefly explaining on what they are first.
Great, thank you.
If I were to go to the doctor, he would do what we call vital signs. That's the first thing to do is check your vital signs. Vital means life, right? It means vital. And if he checks my blood pressure and my pulse and my blood sugar levels and my hemoglobin and all that type of stuff is my respiratory rate, my blood pressure, that's all vital signs. And even though the doctor can't tell me what day I'm going to die, if he took 1,000 people and he examined all of them and got that data on all of them, he'd get a pretty good idea of who he'd bet on to win a marathon or who he'd bet on to outlive the other guy. Now, it's not guaranteed. He could be wrong, but it has an educated guess. That's a lot like fundamental investing because there's certain things about a company, it should be making money. It shouldn't have too much debt. It should have a certain amount of growth. And there's all kinds of metrics, just like that blood pressure and that blood sugar for human being that you have for business. And so that's where Warren Buffett comes in, is he says, I'm not going to buy a stock. I'm going to buy a business. And the mindset is to earn money from dividends and earn money from being in business, just as if you were a non-public company. And that would be value investing or fundamental investing. Now, technical investing is interesting. Once a company goes public, this is important. What happens is let's say you and I, Greg, had a company and maybe we're like Mark Cuban and we start a website and we're broadcasting baseball games around or whatever it is. And people say, gee, this is pretty cool. We'd like to, own some of your company and share in these profits. And you and I say, gee, this would be a great way to raise capital. So we say, well, how much will you give us for ownership in our business? and we would do what's called an initial public offering. We do an IPO, and we'd offer the public the opportunity to buy our company. And we'd probably keep a bunch of shares for ourselves. But that's what happens when a company goes public. And now all of a sudden, instead of just focusing on our cash flow and selling our services, now there's another opportunity for people to buy the stock low and sell the stock high. That's not fundamental investing. That's trading. And it happens all the time, and it's a real thing. And it's probably more important to understand now than it was in 1950, when you could invest more than trade. And I'll explain why that is. So now you have the ability, since people can buy stocks, you have a phenomenon that is occurring right now where we call it, or I call it, a detachment from fundamentals. And what that means is that the price of the stock is no longer really reflective of value for how well the business does, but rather the price is going up or down because of the excitement and the demand for the stock. And that's very important. Supply and demand is now supply and demand of the stock is at the heart of technical analysis. Let me say it again. The supply and demand, the people that want to buy those shares and the people who want to sell those shares, is at the heart of technical analysis. And all technical analysis is studying and analyzing that supply and demand. That's all it is.
So is it like a sociology mindset where you're really just looking at the emotional?
Almost I'd say it's a psychology. Yeah, mass psychology or sociology, but mass psychology it is.
So you're trying to predict the mood or the excitement of
the fear.
The stock in the future.
Yeah, and think about this. The most basic lesson we teach in the 4 pillars of investing is we start with helping people understand something called support levels and resistance levels. And that's easy to understand if you just go to the grocery store or the gas station. If you go to a gas station in the United States where they use gallons, or you go to Canada where they use liters, or wherever you want to go, let's say gas is $2 a gallon. If it goes down to $1 a gallon, people are going to buy more gas. There's going to be a greater demand for that, right? And if they need to sell something, they'll drop the price down low enough to where people begin to buy it. Well, it's very hard to get those prices to zero because people are going to step in and buy stuff, right? It's hard for a stock to go to zero because as it starts to go down, it's just getting so cheap that people can't resist. They'll see a stock like ExxonMobil drop and they'll say, my gosh, it pays a dividend. Look, I might never get it this low again, right? They're not really thinking about the fundamentals of the company at this point. See the detachment?
Yeah, absolutely.
They're just saying, wow, this is cheap. You have companies like Tesla. I don't know what Tesla's stock price is right now off the top of my head because I don't own any, but Tesla has a PE ratio of like 1,200. What that means is you have to spend $1,200 to produce $1 of earnings out of that company, which means you're either going to believe it's going to have 1,200% growth, or you're going to believe that you'll be alive for 1,200 years to get your money back. So buying that as a business doesn't make a lot of sense at that price, but buying it as a stock does. See the difference?
Yeah.
So Warren Buffett looks at buying companies, and he happens to hold the stock because he's the owner of the company. His intent is to make money in the business as an owner. But a technical trader is really looking at the price of stock, and that's all they care about. And they'll say things like, oh, fundamental schmundamentals. We just want to know where the price is heading. And we did a episode on GameStop. See, that was not a fundamental move. That GameStop stock price didn't go up because GameStop sold a bunch of games or solved a bunch of problems or eliminated a bunch of debt or found a new partnership or merged. None of those, nothing fundamentally happened. What happened is the supply and demand for the stock was manipulated, right? As people began to buy it, well, what's going to happen? The price is now going to go higher. So when people stop buying and paying that price, that's called resistance. And when people can't resist and won't let it fall anymore, that's called support. And that's the basic beginnings of technical analysis, is understanding when people buy. if gasoline is $1 a gallon, people are going to load up and fill up their boat, fill up their jet ski, fill up their lawnmower, fill up their car, and they're going to drive everywhere, right? Because it's cheap and it's fun to do, and boom, off we buy gas. But if it goes to say $6 a gallon, people say, I'll ride my bicycle before I pay $6 a gallon. And so it's hard to get prices high. It's hard to get them down too low. And they play based on supply and demand. Well, stocks are the same way. Once the stock goes public, it can be bought and sold like any other product. And that's where that detachment from fundamentals can happen. So in the GameStop situation, you got a stock that goes from $7 to $400 for no reason based on the company, only because now everyone says, well, I decide I want to buy the stock and I think the stock's going to go up. And that brings more people in thinking the stock's going to go up. And then it starts going up. People feel they're missing out. So then they buy, and then it gets to $400 a share and people, that's a little bit rich for a lot of people's blood. And so they stop buying it down. That's technical analysis at its worst.
Okay. How's that different from gambling? You're trying to predict the future. So isn't that just
it's a little different from gambling. It's a little different because if I go to the casino, I know the odds are against me. I mean, the odds are absolutely against me. There's statistical facts and probabilities and, data that will make me lose. I mean, I know over the long term, I can't beat the house. But in technical trading, there's not any of that there. I mean, it's just supply and demand in the market. And some people say that's a bad way to trade. I don't trade that way as much. I still use technical levels, even as a fundamental investor, deciding where I might want to buy something or sell some options to buy something. I might want to sell a call and sell it just outside of resistance. So I will use, as a fundamental investor, likes to buy a stock, get the covered call. Sometimes I got to buy them back because I really do like holding my stock. But I'll still use little technicals. People that don't believe it's technical trading matters, I would just, they can believe what they want, but take a second look, because right now we have something called artificial intelligence that's being developed. We were talking before the program began about what Google does and Facebook does, and the amount of computing that begins to predict people's behavior. China's way ahead of us on this. They can predict people's behavior. They can predict criminality with like 88% accuracy, sexual preference with 80% accuracy, something like that. I mean, almost anything they can predict how you're going to act. Well, I would say that right now, probably 80% of the trading on Wall Street is done by machine. Now, that's significant. And those machines are not using data from fundamentals, because they only release the fundamentals 4 times a year in the quarterly report, right? They're only going to show their earnings 4 times a year and their guidance 4 times a year. So those computers that are trading in microseconds are making decisions based on analyzing buying and selling pressure, supply and demand, support and resistance, and other momentums. And there's hundreds of technical indicators that people use. There's if you were to look at 3 investors, and this is important because people fall into a trap. And if you happen to, ever take notes on this podcast, or at least a mental note, people often fall in the trap of saying, well, this is the best way to do something. And that's simply not true. There's more than one way to raise children. There's more than one way to run a business. There's more than one way to run your marriage. There's more than one way to learn the guitar, the piano. There's always more than one way. And so people say, which asset is best? Is it real estate, stock? They're all great. You can find your way to bankruptcy in all 4 asset classes, and you find your way to heaven in all 4 asset classes, financial heaven. And so a lot of people say, well, fundamental investing is better than technical investing. No, it isn't. If you ask George Soros, he'll do a little fundamental investing on the sovereign level by shorting the yen. That was a fundamental decision based on policy. But he also does a lot of technical trading, and he hires some of the best technical analysts in the world to move on price action. So where Warren Buffett would be very strictly fundamentals, how's the company doing? A guy like Soros would say, hey, how's the buying and selling doing? How's the pressure doing? And there's a third that I don't teach because I'm not smart enough to teach it. Most people aren't. But Jim Simmons is that dude is better than Soros or Buffett. He's the greatest trader I've found ever. His returns over a 20-year period have doubled Warren Buffett's. I mean, he's buried Buffett. He's twice as good as Buffett. And he used what we call quantitative analysis, or what we call quant trading. And he made most of his money in the bear markets because the computer was analyzing the technicals of it. And, quantity is where quant comes from. And so all of these different ways to trade work, and which one is best for you is a personal preference on how you like to spend your time. What do you like to do? It's a lot like playing basketball. What's better? Press defense, zone defense, man-to-man defense. Rick Pitino liked to press, and Boeheim likes the zone, and my old coach Majerus was a man guy. So you can win a championship in all three ways.
Okay, but
and it's true here.
I have two questions for you.
Yeah.
Who owns these AI computers that are making these changes so fast and dictate or predicting the behavior and all that?
You have hedge funds that will use that to trade. There's a great book called Flash Boys that talk about this. There's brokerages. They certainly aren't going to leave their money alone. It's funny how brokers are. They'll tell their customers, look, just buy the stock and hold it till you die, no matter what. Don't panic. Don't mess with it. Just don't touch it. Buy it and hold it. And the very moment they shut the door, what do? They're trading. I mean, there's volume in the market every day, right? There's trading and reaction and knee jerks. And Jerome Powell says something and people, react. Or there's something overseas, people react. The European Central Bank changes rates, they react. So there's micro, trading in microseconds, high frequency trading with massive amounts of money that only need that far of a move to make money. And so, really, fundamental analysis, the shorter time frame you're trading in, whether you're a day trader or a high frequency trader, fundamentals are meaningless because you're trading minute by minute, and the fundamentals don't change minute by minute, but the technicals do.
Okay,
and I recommend learning both.
You mentioned the quantum trading. If those computers are out there and they're so powerful, how does a common guy like me, or even a super educated guy like you, how do you compete with that?
I'm really glad you brought that up, because that is the idea. It's like, well, am I competing against that? And the answer is no, I'm not. I'm not competing against it. I'm not playing that same game. Think of it this way. There's so many reasons for a stock to go up and down. I mean, there's infinite reason for a stock to go up and down, right? And whether the stock is being manipulated by, some huge firm, or whether the stock does poor fundamentally, or whether the stock does well fundamentally, or whether there's, last week we talked about, geographic risk. There's a freeze in the orange crop, right? I mean, it could be a legislative risk. And so there's all kinds of things anyway that can change the stock. And so as I invest, or as I trade, I do more investing than I do trading. I invest in stocks and I trade options would probably be the best way to talk about it, because options expire. So you're going to be trading those. But yeah, I look at those charts and those prices and the fundamentals the same way, because I don't care if someone's buy, sell, buy, sell, buy, sell, buy, sell. I'm not trying to beat them at that game. I make money if I buy low or sell high, or if I buy low, sell option premium and collect dividends. I make money if I do that. If the stock drops, I can lose money. If they cut the dividend, I have risk like anybody else. I've won, I've lost like anyone else. But I don't compete with those guys at all, because stocks can go up and down for any reason. I don't have any fear at all when I teach my son to trade, say, now these high frequency traders are doing their thing. No, I'm just looking at the chart and I say, look, it can go three ways, up, down, or sideways. Here's our plan for up. Here's our plan for down. Here's our plan for sideways. Okay, what more do I have to worry about? It can only go those three directions.
Right.
And if I have a good plan, who cares what caused it to go up, down, or sideways, right? If I have a good plan.
Gotcha. So
Technicals are also important for risk management. If I want to put a stop loss on something, I like to have a little technical skill. There's so many different types of technical tools, from day-to-day candlesticks to oscillators like MACDs and stochastics, and there's things like Bollinger Bands. There's hundreds of them to learn. If you want to learn, you don't need to learn them all. I haven't learned them all, but I have a handful that I like. An average true range is a technical indicator that tells me the average wiggling of that stock price of a day on average. And if I want to set a stop loss on something, I can set it just outside of that ATR. And now if it wiggles further and goes down, I want to get out because I know, okay, something out of the ordinary is happening here. Something's not good. And yet if I put my stop too tight, I get out and it goes in without me. So that ATR is a nice one to, find a multiple of. There's so many we're getting in the granularity of the tools, but the big picture is fundamentals is about how the company operates and the health checkup of the company. Technical analysis is just analyzing and watching how the price moves historically based on supply and demand. And we use computers to create standard deviations and figure out what there's something called the Fibonacci retracement Fibonacci numbers, all these, Gerald Appel, I think he was nominated Nobel Prize for the moving average conversions to versions. You can rattle off all these things, but that's part of your financial vocabulary. And for me, it's fun. I think, I didn't like chemistry and physics, but I liked studying investing, and it was fun for me to learn.
Okay, just to pull it back, because you said a lot of fancy words and names.
Yeah, it's granular. Yeah.
But if I'm to say the Andy Tanner big picture generic strategy would be look at the fundamentals first, but then also supplement your decision making with the technicals.
Yeah.
And it's really a combo. But if I had to say, the fundamentals are probably 70% of your decisions and the technicals 30.
Well, I don't know. It depends on the stock and what I'm trying to do, right? Where I'm leaning. If I am in the airport, I'm bored and I want to day trade, I'm not going to worry about fundamentals at all. But if I'm looking at something, I want to build legacy for my children, it's probably almost all fundamentals, and I don't care about the technicals at all. So it depends on what I'm doing. I tell people, the most popular class I ever created and the most successful one I ever created is a simple class called the 4 Pillars of Investing. 4. The first 2 pillars have to do with getting information, fundamental analysis, technical analysis. And I can't control what that information, it is what it is. The chart, I can't make the chart move, and I can't make the company sell more stuff. It's out of my control. So it's information only. So fundamentals and technicals give me an idea of what I feel about the stock. And I develop what's called a stock opinion. Now I have an opinion. Well, based on the fundamentals, I think this, and based on the technicals, I think this. And so now I have a kind of a rich knowledge and an idea about the stock. The other 2 pillars are what we call cash flow and risk management. And cash flow and risk management is where I have all the control in the world I want. I can decide whether I want to go long or short, whether I want to use an option trade, whether I want to buy the stock or get dividends or whatever, write covered calls, whatever I want to do to generate cash flow out of it. Do I want a cash flow trade, an income trade, a capital gain, speculation? What do I want? How do I position myself? Then that last one, risk management, is the most important one. That one's always there. And I use a little bit of technical analysis to help me decide how I will manage that risk at times. And so that's important stuff, especially with option trading. I think technicals, if you are a stock trader only, maybe less important, but if you're going to trade options along with your stocks to supplement that, which I think that's a Warren Buffett deal. I mean, Warren Buffett is absolutely using those 4 pillars when he trades. Even a guy like Warren Buffett is going to decide at what level value-wise he's willing to buy that stock at, and when he sells an option to have the stock put to him. So yeah, those are the 4 pillars: fundamentals, technicals, cash flow, risk management. We've focused mostly on that second pillar today, which is price action, the study of supply and demand, the study of watching the chart. Basically, it's how to read a chart, a lot of people, I think, would like the idea of popping up a stock chart on the computer, and then it would have meaning. I think Robert Kiyosaki taught this very well when he said, Andy, information without education has no meaning. Isn't that a great phrase?
Yeah, absolutely.
Information, the chart, without education, the knowledge, is meaningless. It just will be written in a foreign language and be in a coloring book. It doesn't say anything to me. But what our 4 Pillars class does, which I'm very proud of, I'm not apologetic in recommending it at all, because what the 4 Pillars does is it starts bringing meaning to people. It's really fun to watch them grow, because they'll go from knowing nothing about this stuff and they'll be down on themselves. This is too hard for me. I'm not very smart. I'm too old to learn. I'm too young, whatever their little voice says. And all of a sudden, after a little bit of practice, they're like, oh my gosh, I can't believe everything I'm seeing. And my son's 15 years old and he's turning into a not too bad of a technical analyst. He can look at a chart and he can see meaning in it. He can say, look, they couldn't make up their mind what to do. There's a candlestick called a doji. That means indecision. Now look, the market could, he can see a death cross or a golden cross on moving averages. And it's fun to have meaning. And it's a great way to educate yourself. So that's
great, Andy. Andy, thank you. I would have told the world you were a fundamental guy. So it's nice, honestly, to hear the second side and to hear that you really do use both.
I do.
Yeah, that's awesome. And to the listeners, I do not have a link for the 4 Pillars class. I'm sorry, but I do have a link to some of Andy's free training.
I think that's the best place to start, with the free stuff, man. And then, once you dip your toe in the water, if it feels good, we'll dive in at that point.
Yeah, that sounds great. Andy, thank you so much once again.
Thank you, Greg. Again, I thank everyone for tuning in, and I respect people that invest a little bit of time, half hour or so, into learning about something. There's many people that give a lot of lip service to wanting to get better, and yet they don't show up and watch videos, and it's here for you. So
right.
If there's anything we can do, type it in the comments. If there's something you'd like us to cover, we read those comments and we listen. And so if you have a topic you'd like us to hit or touch on, we'd be happy to accommodate.
Well, thank you, Andy. And speaking of the comments, to everybody out there, I am not stoned. This is just how I look. Sorry, guys. All right, Andy, let's get out of there.
We'll see you, Greg.
later. All right,
bye. Bye-bye.